Hello, your Phoenix real estate market update is starting right now. I'm Caitlin McKegg. I am a real estate broker here in Phoenix, Arizona. Happy Monday to all of you. Thank you for coming to watch this video. This is Cleo over here. She's gonna lay there, I think, for the video, and Zoe is in the other room. If you didn't notice, I am a little bit sick this week, was traveling and it got the best of me. So I'm gonna try to get through this as best I can without coughing, and I apologize for my voice in advance. But let's get rolling here. First of all this information that I provide, some things that I've sourced on my own, some just from my experience as a real estate broker in Phoenix, and also some from the Cromford report, which is a subscription that I have and follow. They have excellent data for realtors to use and share with their clients. If you're new here, make sure you hit that subscribe button and the bell for notifications so you don't miss these updates. I am here every Monday. So let's start, as I have been doing lately, with talking about things on kind of a broader scale. Let's start talking about interest rates and where they're at. Last week, they went down slightly, 5.09% from 5.1%. Woohoo. But, you know, we'll take good news when we can. When you look at the difference between this year and last year at this time, rates were around 2.99%. So that's a difference of 2% in the last year, a 2% increase. And if you were looking for a home last year and looking in that same price range today, just with the difference in rates, you would need to make $30,000 more in order to qualify, or in order to have, really to qualify for that mortgage payment. So it's a really stark difference between where we were at last year to where we are now with rates, not to mention price increases. So with these rates changing as fast as they have been, we are definitely seeing a decline in our demand and buyers dropping out of the market because they simply can't afford anything anymore, or they don't want to be that stretched, even if they could afford it. So this is having a significant effect. Mortgage applications are down now to the lowest rate we've seen since December of 2018. Not surprising. That was when the market was a bit more normal. 19 picked up a bit, and then 2020 and beyond is like, what the heck happened? So 2018 in December is the last time we saw mortgage applications at the rate that we're seeing now. So that's what's going on in the world of rates. The Fed still intends to hike interest rates another 50 basis points in June and July. That's what they've announced. And it doesn't seem like that's changing, regardless of how the jobs report came out. So I want to talk about that. We just got the May jobs report out on Friday, and the non-farm payrolls, we added 390,000 jobs in May, and it was expected that we would sorry, I crossed that out there. It was expected that we would only add 318,000. So we outpaced that, which is great. Our unemployment rate is 3.6%. It was expected to be 3.5%. I believe in April it was also 3.6%, so not much of a change there. And then the wage increases, 5.2%. It came out to be, and they anticipated it being 5.2%, so right on the money there. In April, wage increases or wage growth was about 5.5%, so that went down a little bit. And so the good news, bad news with this report is that, yay, it shows that we have a strong labor market still, at least in the numbers. But the bad news is that this isn't going to change where the Fed is heading. This is only going to continue them on the path of hiking interest rates because we're seeing such a strong labor market. Now, people are arguing that this is a lagging indicator, which I agree with. There's a lot of reports right now about layoffs in various industries due to inflation and the change in consumer spending. So retail seeing that, the tech industry is seeing that as well. And so seeing that those types of things are being affected, we'll probably see that more, I would say, maybe in the June job numbers, maybe July. I don't know all of this all that well. I'm not an economist, but from what I follow, that makes a lot of sense. And it does seem like this is a bit of a lagging indicator. So regardless, labor market looks strong, but that could definitely change when we get the job reports in the next month or two. And this is probably not going to change any course of where we're headed with interest rates, but we'll see. So let's talk about 2008 versus today, because as things start to change in the market, people love to talk about a market crash, and people love to talk about reliving 2008 and, whether or not we're going to have a crash, a correction, a stabilization, or an increase. The factors going into where we're headed today are much different than where we were at in 2008 or going into 2007 and 2008. So anything could happen, but we're not in the same situation. We're not having those same symptoms going into 2008. So one of the things that is different, I'm going to talk about two things. There were many things that went into the crash, but one thing was our lending practices, which have been changed since. This is a graph showing the volume of loans in the billions to people with a credit score less than 620. And you can see in 2003 through 2007, we were going a little wild with that. So I think we peaked at, this is $375 billion of loans that were given to folks with a credit score of less than 620. So even if they had an intention maybe of paying that back, they weren't able to for whatever reason. And it just wasn't smart to give away that much money to people that have already said, I don't pay back my loans. Now here in 2022, we're at about 20 billion going out to people with a credit score lower than 620. And I think there's some other stipulations around that as well. So not only have we lowered that number, but I think there's a few other hoops people have to jump through. And then, clearly with all of these blue bars here, we've corrected this. It's been much less over the last decade, 14 years or so, in terms of the amount of money that we're lending out and what those credit scores are. So this is one of the factors that really killed us in 2008, and today will not be a factor if we do have any sort of crash or correction or whatever you anticipate. Lending standards have been changed, and this is not going to be one of those factors. The other thing that happened is we had a massive oversupply of homes on the market. This is Phoenix specific, this little chart here, and we were at about 54,000 listings around this time in 2007 and 2008. And today we're at about 10,000. Now, we've had a huge increase in our active listings. We were at about 4,000 or so earlier this year when we started the year, 5,000-ish. And now we're at 10,000. So we've doubled. So that feels crazy, but 10,000 is still a really low number of active listings for Phoenix, especially when you compare that we were at 54,000 back in 07 and 08. So that oversupply of homes plus our lack of demand was what really put us into a bad situation. If we go down to this bottom graph down here, this is the Cromford index, which I'll talk more about in a bit, but just wanted to show the demand line is the red line, and this was 50% below normal for demand at that time. So not only did we have a massive oversupply of homes at 54,000 when a normal amount is like 20,000, we had half the demand that we should. So those two factors being so far apart just totally tanked home values because no one was going to buy all of these homes that were on the market. Now, today, the situation is different because we have a very big undersupply of homes on the market. We have more demand than supply, but even if that demand backs off as it has, we still don't have enough supply for people that want to buy homes. So this report that I got from Realtor.com's Economist is that we've created 5.8 million more households in the last 10 years. And we build homes at a rate of about 1.1 million per year. So in essence, we're about 5 years behind in building for our population. And that's on a national scale. I think for Phoenix, I don't know those numbers exactly. I've seen them in the past, but don't remember them enough to quote them here. But I know we're at least around that 5-year mark, if not more, behind in building in Phoenix, because we're one of the places that were hit the hardest back in 2008, and we just stopped building. Meanwhile, our population continued to increase, and we weren't building homes for them, and so on. So over the last 10 to 12 years, things have really gotten very, very constrained in terms of our supply. So those are two factors to keep in mind as people love to talk about the gloom and doom of 2008 and market crashes and whatnot, and put all that clickbait out there. We do have two things that are very different for us this time around, which is our supply factor being undersupplied and that our lending practices are much tighter today than they were in the past. So moving on, let's talk about the Cromford Market Index. If you're new here, the Cromford report has created this index that gives us an idea of supply and demand factors in our market. And if the index is anywhere between the range of 90 to 110, it means we are in a balanced market or a normal market. And if it's above 110, we're in a seller's market. And if it is below 90, we're in a buyer's market. So we have been above 110 for quite a while in a very strong seller's market, but over the last 2 months, that has been weakening like heck. Like I've never seen before. That number is going down quickly. And so this is a list of all of the major cities throughout the Phoenix area and what their respective CMI is. And over the last month, the average decline of all of these cities has been 33%, which is accelerating because last week, the average decline over the last month was 28%. So just showing that that CMI is continuing to go in a downward direction. The most affected cities are Avondale, Gilbert, Cave Creek, and Queen Creek. All of those have seen at least a 37% decline in their CMI over the last month. So that was higher than the average of 33%. Now, the only city that hasn't been quite as affected in their decline is Paradise Valley at 22%. But what's interesting to look at here is you can see last month what every city's number was. And you'll note that there's like quite a few in the 400s and 500 last month. I mean, look at Avondale, 521 last month, and now they're at 284. That is a 45% decline. That's huge. And then, you know, a few others in the 400s, and now there are no cities in the 400s at all. That's how much things have changed in just a month. So the Cromford report does say, and I want to read this specifically, they do say that the market has deteriorated at the fastest rate we've ever seen. It says that last time we saw a similar frenzied market cool down very quickly was in April to November of 2008. This is a more striking reversal than we experienced even that year. So again, not to say that's where we're headed, but the way the market is changing is just as rapid as it did then. I think we have other factors at play in this market. We're not oversupplied, but on the heels of a possible recession, not really knowing what's coming our way, I can understand how this makes some people nervous, and we don't really know exactly what's to come from here. So let's look at the CMI overall. We're at 261.4. This was as of June 4th. So today on June 6th, it may be slightly lower than that. Demand is 95. So that's right in that normal range, but we're starting to get down almost to below normal for demand. As soon as we get below 90, that's going to be below normal for demand. So we're kind of headed that way. And then supply has gone up again to 36.3. Again, still undersupplied, still about 64% below normal, but it is going up. It's, I mean, maybe a month ago, I don't even know if it broke 30 yet. So that has increased pretty quickly in terms of our supply. So overall, the bottom line of what's going on in the market is that our supply is increasing, our demand is going down, our sales volumes are going down, the asking prices are starting to be lowered more often, and listing cancellations and expireds are going up. So these are all factors showing a really big softening in our market. Keep in mind, prices are continuing to rise when we look at a year-over-year basis or even month-over-month. And so until we have an oversupply of homes and no demand, we're not going to see home values decrease, but we are starting to see the fact that as a seller, you're not going to get as much for your home maybe today as you would have last month, just because there's not a bidding war anymore. Now, I'm not saying there are no bidding wars at all. That's not correct. I'm hearing of them happening in a lot of different places still. Really depends on the type of house and the location. But largely around the valley, we've started to see a cool down to the point where you might get one offer in the first week and not 10 in the first day. So things have certainly changed. If you've been considering selling your home, this might be a good time to really think about pulling the trigger, because who knows where we're headed. Obviously, things have changed and your leverage as a seller is weakening every day. If you're a buyer and you've been waiting to buy, you have less competition right now, and I think a lot of sellers are interested in making something work if they have to sell, because they don't really know where we're headed. So you may have an advantage as a buyer. So whether you're thinking of buying or selling, I can help you with that. Please keep that in mind and feel free to reach out to me anytime with questions or to talk about your situation. I think that's a wrap. I'm gonna give my voice a rest. Gotta tell you, it was really hard to get through this, so thank you for bearing with me. But if you have any questions, you can always reach out or comment below. In the description below, I do have a link to check your instant home value or search my MLS for homes for sale. So thanks so much for watching. I appreciate you guys coming back every week. Make sure you subscribe. I'm Caitlin McKegg with the Desert Dreamers team at HomeSmart.